Hello everyone, welcome to the 37th episode of me learning how to trade using Forex. So in the last video we went through the previous lesson of this one, which is what is a pip in Forex. So we went through all of this, made some notes, and now we moved on to what is a lot in Forex. So yeah, let's get started then. Oh no, that's not the right way. Do that. Here we go. Okay, so what is a lot in Forex? Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount. When you place orders on your trading platform, orders are placed in sizes quoted in lots. It's like an egg carton or egg box in British English. When you buy eggs, you usually buy a carton or a box. One carton includes 12 eggs. The standard size for a lot is 100,000 units of currency, and now there are also mini, micro and nano lot sizes that are 10,000, 1,000, 100 units. So standard lot is 100,000, mini lot is 10,000, micro lot is 1,000, nano lot is 100. Some brokers show quantity in lots, whilst other brokers show the actual currency units. As you may already know, the change in a currency value relative to another is measured in pips, which is a very, very small percentage of a unit's currency value. To take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Let's assume we'll be using 100,000 unit standard lot size. We will now recalculate some examples to see how it affects the pip value. USD/JPY at an exchange rate of 119.980, so that is 0.01 divided by 119.80 times 100,000 equals $8.34 per pip. USD/CHF at exchange rate of 1.455, so that's 0.00001 over 1.14555 times 100,000 equals $6.87 per pip. In cases where the US dollar is not quoted first, the formula is slightly different. Euro USD at an exchange rate of 1.1930, so that's 0.0001 divided by 1.1930 times by 100,000. It's the same as oh no, equals 8.38, and then times by 1.9300 equals 9.99734. Rounded up will be $10 per pip. GBP/USD an exchange rate of 1.8040 is 0.0001 times 1.8040 times 100,000 equals 5.54, and then retimes that by 1.8040, which is 9.99416. Rounded up should be $10 per pip. Here are examples of pip values for Euro USD and USD/JPY depending on lot sizes. Pair closing price any units 0.0001, standard lot 10, mid lot, micro, nano. USD JPY, USD equals 80 JPY 0.12, 1.25, 10, 0.125, 0.0125. Your broker may have a different convention for calculating pip values relative to lot sizes, but whatever way they do it, they will be able to tell you what the pip value is for the currency you're trading at that particular time. In other words, they do all the maths calculations for you. As the market moves, so will the pip value depending on what currency you're currently trading. Standard lot is one lot's 100,000 units of currency, mini lot is 10,000, micro lot is 1,000, nano lot is 100. A standard lot represents $10 a pip when using EUR/USD as a base currency. A mini lot represents $1, micro lot is 0.1, and nano is 0.01 of a pip. $10 a pip when using a EUR/USD as a base currency. What the heck is leverage? You're probably wondering how a small investor like yourself can trade such large amounts of money. Think of your broker as a bank who basically fronts you 100,000 to buy currencies. All the bank asks from you is that you give it 1,000 as a good faith deposit, which it will hold for you but not necessarily keep. Sounds too good to be true? This is how Forex trading using leverage works. The amount of leverage you use will depend on your broker and what you feel comfortable with. Typically, the broker will require a deposit, also known as a margin. Once you have deposited your money, you will then be able to trade. The broker will also specify how much margin is required per position lot traded. For example, if the allowed leverage is 100 to 1 or 1% of position required, and you want to trade a position worth 100,000 but you only have 5,000 in your account, no problem, as your broker would set aside 1,000 as a deposit and let you borrow the rest. Of course, any losses or gains will be deducted or added to the remaining cash balance in your account. The minimum security margin for each lot will vary from broker to broker. In the example above, the broker required a 1% margin. This means that for every $100,000 traded, the broker wants 1,000 as a deposit on the position. Let's say you want to buy one standard lot of USD/APY. If your account is allowed 100 to 1 leverage, you will have to put up 1,000 as margin. The 1,000 is not free, it's a deposit. It's not a fee, it's a deposit. You get it back when you close your trade. The reason the broker requires deposits is that whilst the trade is open, there's the risk that you could lose money on the position. Assuming that this USD/JPY trade is the only position you have open in your account, you would have to maintain your account's equity, absolute value of your trading account, of at least 1,000 at all times in order to be allowed to keep the trade open. If USD/JPY plummets and your trading losses causes your account equity to fall below 1,000, the broker system would automatically close out your trade to prevent further losses. This is a safety mechanism to prevent your account balance from going negative. Understanding how margin trading works is so important that we have dedicated a whole section to it later in the school. It is a must read if you don't want to blow up your account. Moving on for now. Okay, moving on for now. How the heck do I calculate profit and loss? So now that you know how to calculate pip value and leverage, let's look at how you calculate your profit or loss. Let's buy US dollars and sell Swiss francs. The rate you are quoted is 1.4525 slash 1.4530. Because you are buying US dollars, you'll be working on the ask price of 1.4530, the rate at which traders are prepared to sell. So you buy one standard lot size 100,000 units at 1.4530. Because you're buying US dollars, you'll be working on the ask price. A few hours later, the price moves to 1.4550 and you decide to close your trade. The new quote for USD/CHF is 1.4550 and 1.4555. Since you initially bought to open the trade, to close the trade, you must now sell in order to close the trade. So you must take the bid price of 1.4550, the price that traders are prepared to buy at. The difference between 1.4530 and 1.4550 is 0.0020 or 20 pips. Using our formula from above, we now have 0.0001 divided by 1.4550 times 100,000 equals $6.87 per pip. Times that by 20 pips, you get $137.40 of profit. Remember, when you enter or exit a trade, you are subject to the spread in the bid/ask quote. So, when entering or exiting a trade, you are subjected to the spread in the bid/ask quote. When you buy a currency, you will use the offer or ask price. Use offer, use ask price. When selling currency, use bid price. When you buy a currency, you will use the offer or ask price. When you sell the currency, you will use the bid. So when you're selling it, use a bid. No, you must sell in order, so you take the bid price at that. Next up, we'll give you a roundup of the freshest Forex lingos you've learnt. What is a spread in Forex trading? Forex brokers will quote you two different prices for a currency pair, the bid and ask price. The bid is the price at which you can sell the base currency, the ask is the price at which you can buy the base currency. Bid is sell, ask is buy. Use ask price. The difference between these two prices is known as a spread. When buying currency, use ask price. When selling currency, use the bid price. Between them is known as the spread, also known as the bid-ask spread. The spread is how no commission brokers make their money. The spread is the fee for providing transaction immediacy. This is why the terms transaction cost and bid-ask spread are used interchangeably. Instead of charging a separate fee for making a trade, the cost is built into the buy and sell price of the currency pair you want to trade. From a business standpoint, this makes sense. The broker provides a service and has to make money somehow. They make money by selling the currency to you more than they pay to buy it. And they also make money by buying the currency from you for less than they will receive when they sell it. They also make by buying the currency from you for less than they will receive when they sell it. Right, the difference is called the spread. It's just like if you're trying to sell your old iPhone to a store that buys used iPhones. A smartphone with only 2 rear camera, yuck. In order to make a profit, you will need to buy your iPhone at a price lower than the price it will sell for. Buy your iPhone at a lower price than it will sell for. If it can sell the phone for $500, then if it wants to make you any money, the most it can buy from you is $4.99. That difference of $1 is a spread. So when a broker claims zero commissions or no commission, it's misleading because whilst there is no separate commission fee, you still pay a commission. It's just built into the bid-ask spread. How is the spread in Forex trading measured? The spread is usually measured in pips, which is the smallest unit of a price movement of a currency pair. Measured, which is the smallest unit of the price movement of a currency pair. For most currency pairs, 1 pip is equal to 0.0001. An example of a 2 pip spread for Euro USD would be 1.1051/1.1053. That is a 2 pip spread because 1.1053 minus 1.1051 equals 2. Currency pairs involving the Japanese yen are quoted to only 2 decimal places unless there are fractional pips, then it's 3 decimals. For example, the USD/JPY would be 110/110.04. This quote indicates a spread of 4 pips. Okay, so usually measured in pips. 1 pip, 0.0001. 4 pips, 1 JPY pip equals 0.01. What types of spreads are there in Forex? The type of spreads that you see on trading platform depends on Forex broker and how they make money. There are two types of spread: fixed variable, also known as floating. Fixed spread, variable spread. So fixed spread, so it's a set amount above the point, whereas variable is it's a bit less regular. Fixed spreads are usually offered by brokers that operate as a market maker or dealing desk model, where variable spreads are offered by brokers operating a non-dealing desk model. What are fixed spreads in Forex? Fixed spreads stay the same regardless of what market conditions are at any given time. In other words, whether the market is volatile like Kanye's moods or quiet as a mouse, the spread is not affected, it stays the same. So fixed spreads stay the same regardless of the market's condition at any given time. Fixed spreads are offered by brokers that operate as a market maker or dealing desk model. Using a dealing desk, the broker buys a large position from the liquidity providers and offers these positions in smaller sizes to traders. This means that the broker acts as a counterparty to their clients' trades. Having a dealing desk allows a Forex broker to offer fixed spreads because they are able to control the prices displayed to their clients. Acts as a counterparty. What advantages of trading with fixed spreads? Fixed spreads have smaller capital requirements, so trading fixed spreads offers a cheaper alternative for traders who don't have a lot of money to start trading with. Trading with fixed spreads also makes calculating transaction costs more predictable. Since spreads never change, you're always sure of what you can expect to pay when you open a trade. What are the disadvantages of trading with fixed spreads? What are fixed spreads in Forex? What are the advantages? Include smaller capital requirements, makes calculating transaction costs more predictable, always sure of what you can expect to pay when you open trade, of what you can expect to pay when opening a trade. What are the disadvantages of trading with fixed spreads? Requotes can occur frequently with trading fixed spreads since price is coming from just one source, your broker. So, disadvantages include requotes can occur more frequently, and by frequently we mean almost as frequent as Instagram posts from Kardashian sisters. There will be times when the Forex market is volatile and prices are rapidly changing. Since spreads are fixed, the broker won't be able to widen the spread to adjust for the current market conditions. So if you try to enter a trade at a specific price, the broker will block the trade and ask you to accept the new price. You will be re-quoted with a new price. The re-quoted message will appear to you on your trading platform, letting you know that price has moved and asks you whether or not you are willing to accept that price. It's almost always a price that is worse than the one you ordered. Almost always a price that is worse than. Slippage is another problem. Slippage When prices are moving fast, the broker is unable to consistently maintain a fixed spread, and the prices that you finally end up after entering a trade will be totally different than the intended entry price. Slippage is similar to when you swipe right on Tinder and agree to meet up with that hot gal or guy for coffee, and realise that the actual person in front of you looks nothing like the photo. Oof. Slippage. Occurring. What are variable spreads in Forex? As the name suggests, variable spreads are always changing. With variable spreads, the difference between the bid and ask prices of currency pairs is constantly changing. Whoops. Don't. What am I doing? Variable spreads are always changing. Whoops. The difference between the bid and ask price are constantly changing. Variable spreads are offered by non-dealing desk brokers. Non-dealing desk brokers got their pricing of currency pairs from multiple liquidity providers and pass on these prices to the trader without the intervention of a dealing desk. This means that they have no control over the spreads, and the spreads will widen or tighten based on the supply and demand of currencies and the overall market liquidity volatility. So, spreads will widen or tighten based on the supply and demand of currencies and overall market liquidity. Typically, spreads widen during economic data releases as well as other periods when the liquidity in the market decreases, like during holidays or when a zombie apocalypse begins. Spreads typically widen during economic data releases and other periods when the liquidity in the market decreases. Normal spread 2 pips. Wide spread 20 pips. What the fuck? For example, you may want to buy the Euro USD or Euro USD with a spread of 2 pips, but just when you're about to click buy, the US unemployment report is released and the spread rapidly widens to 20 pips. Oh, and the spreads may also widen when Trump randomly tweets about the US dollar when he was still the president. The United States should not be penalized because we were doing so well. Tightening now hurts all that we've done. The US should be allowed to recapture what was lost due to illegal currency manipulation and bad trade deals. Debt coming due, and we are raising rates. Really? China, the European Union, and the others have been manipulating their currencies' interest rates lower, whilst the US is raising interest rates, whilst the dollar gets stronger and stronger with each passing day. taking away our big competitive edge as usual, not a level playing field. What are advantages of trading with variable spreads? Variable spreads eliminate experiencing requotes. Advantages include no requotes. This is because the variation in the spread factors in changes in price due to market conditions. But just because you won't get requoted doesn't mean you won't experience slippage. Trading Forex with variable spreads also provides more transparent pricing. So, more transparent pricing. Especially when you consider that having access to prices from multiple liquidity providers usually means better pricing due to competition. True? What are the disadvantages of trading with variable spreads? Disadvantages include variable spreads aren't ideal for scalpers. The widened spreads can quickly eat into any profits that scalpers make. Not for scalpers. Variable spreads are just as bad for news traders. Spreads may widen so much that what looks like a profitable can turn into an unprofitable within blink of an eye. Are just as bad for news traders. Fixed versus variable spreads, which is better? The question of which is a better option between fixed and variable spreads depends on the need of the trader. There are traders who may find fixed spreads better than using variable spread brokers. The reverse may also be true for other traders. Generally speaking, traders with smaller accounts and who trade less frequently will benefit from fixed spread pricing. So traders with smaller accounts and who trade less frequently will benefit from fixed spread. Traders with larger accounts who trade frequently during peak market hours when spreads are the tightest will benefit from variable spreads. Traders with larger account and who trades frequently will benefit from variable spreads. Traders who want fast trade execution and need to avoid requotes will want to trade with variable spreads. Traders who want fast trade execution and need to avoid requotes will benefit from variable spread. Spread cost and calculations. Now that you know what a spread is and the two different types of spread, you need to know one more thing: how the spread relates to the actual transaction costs. It's pretty easy to calculate, and all you need are two things: the value per pip for the number of lots you're trading. Let's look at an example. The spread in pips is 1.4 because it's 1.35640 minus 1.35626 equals 0.00014 or 1.4 pips, the spread in pips. In the quote above, you can buy Euro USD at 1.3535640, so that's that one on the right, and sell EUR USD at 1.35626, and that's the one on the left. This means if you were to buy the Euro USD and then immediately close it, it will result in a loss of 1.4 pips. Yes, because you buy it at 640 and you sell it at 626, so then one minus away from another, one minus the other equals 1.4 pips. To figure out the total costs, you would multiply the cost per pip by the number of lots you're trading. So if you're trading mini lots like 10,000 units, the value per pip is $1. So your transaction will cost $1.4 to open this trade. 1.4 times 1 mini times 1.4. The pip cost is linear. This means that you will need to multiply the cost per pip by the number of lots that you're trading. If you increase your position size, your transaction cost, which is reflected in the spreads, will rise as well. So pip cost is linear. This means you will need to multiply the cost per pip by the number of lots you're trading. If you increase your position size, your transaction cost, which is reflected in the spreads, will also rise as well. For example, if the spread is 1.4 pips and you're trading 5 mini lots, then your transaction cost is $7 because 1.4 times by 5 times by 1, and that equals 7. Okay, impress your date with Forex lingo. As in any new skills that you learn, you need to learn the lingo, especially if you wish to win your love's heart. You, the newbie, must know certain terms like the back of your hand before making your first trade. Some of these terms you already learned, but it never hurts to do a little review. Major and minor currencies. The 8 most frequent traded currencies are called the major currencies or the majors. These are the most liquid and the most sexy. All other currencies referred to as minor currencies. So, major currencies, 8 most traded, and liquid currency. Base currency. The base currency is the one on the left, isn't it? Is the first currency any currency pair? Yep. First currency in any. It will always equal to 1 as well. The currency quote shows how much the base currency is worth as measured against the secondary currency, or the second currency. For example, if the USD/CHF rate equals 1.6350, then 1 USD is worth 1.6350. Yep, in the Forex market, the US dollar is normally considered the base currency for quotes, meaning that quotes are expressed as unit of 1 USD per the other currency quoted in the pair. The primary exception to this rule are the British pound, the euro, and the Australian and the New Zealand dollar. Quote currency. The quote currency is the second currency any currency pair. So, quote currency, second currency in any currency pair. This is frequently called the pip currency, and any unrealized profit or loss is expressed in this currency, the pip currency. And the pip is the smallest unit of price for any currency. So pip, smallest unit of price for any currency. Nearly all currency pairs consist of 5 significant digits, and most pairs have the decimal point immediately after the first digit. That is, URUSD equals 1.2538. So there's only one number before the decimal point, or one digit. In this instance, a single pip equals the smallest change in the fourth decimal place, so that's 8. That is 0.0001. Therefore, if the quote currency any pair is USD, then 1 pip always equal 1/100th of a cent. Notable exceptions are pairs that include the Japanese yen, where a pip equals 0.01. So, two numbers after the decimal point, or 2 digits. Pipette, 1/10 of a pip. Some brokers quote fractional pips or pipettes for added precision in quoting rates. For example, if URUSD moved from 1.32156 to 3.12158, it moved 2 pipettes. Bid price. The bid is the price at which the market is prepared to buy a specific currency pair in the Forex market. So, bid price. The price at which the market is prepared to buy a specific currency pair. At this price, the trader can sell the base currency. It is shown on the left side of the quotation. At this point, the trader can sell the base currency. For example, in a quote GBP/USD of 1.8812/115, the bid price is 1.8812. This means you sell £1 for 1.18812 USDs. Yep. Wait, /15. You sell £1. I thought it'd be for 15. Oh no. For 1 point. You sell £1. The bid price is that 1.8812. This means that you sell £1 for 1.8812 USD. Right, okay, yeah. I just don't see where that 15 came from, but bid price is usually where is it? Selling. That's bid price is when you sell it. The bid price is that. This means you sell £1 for 1.8812. Yep. Ask offer price. The ask offer price at which the market is prepared to sell a specific currency pair in the Forex market. So how much you're trying to pay. You are trying to pay. The price at which the market is prepared to sell a specific currency pair for. At this price you can buy the base currency. It is shown on the right side of the quotation. You can sell the base currency here. You can buy the base currency. You can buy the base currency here. For example, in a quote URUSD 1.2812/15, the ask price is 1.2815. So they're selling it for 1.2815. That means you can buy €1 for 1.2815 USD. The ask price is also known as the offer price. Bid ask spread. The spread is the difference between the bid and ask price. Yep. The big figure quote is a dealer expression referring to the first few digits of an exchange rate. These digits are often omitted in dealer quotes. For example, the USD JPY rate might be 118.30/118.34, but would be quoted verbally without the first three digits as 30 to 34. In this example, JUSD/JPY has a 4 pip spread. Oh, so they missed out the 118 and the 118 here. The big figure quote is the first few digits. Bid ask spread, yep. So, what's it called? The big figure quote. Dealer expression of leaving out digits before the decimal point and only saying the digits after the decimal point. Digits, so it's USD slash JPY could be 118.30 slash 18.34, but would be quoted verbally at 30/34. In this example, USD/JPY has a 4 pip spread. Yep. Quote convention: exchange rates in the Forex market expressed using the following format: base currency, quote currency equals bid/ask. Okay, so exchange rates quoted using the following format: base currency slash quote currency equals bid slash ask. Transaction cost. The critical characteristic of a bid-ask spread is that it is also the transaction cost for a round turn trade. Round turn means to buy or sell trade and an offsetting sell or buy trade of the same size in the same currency pair. For example, in the case of a USD rate of 1.2815 over 15, the transaction cost is 3 pips. Oh, I just realised the 15 is meant to be 1.2815, so 3 pips would then be 15 minus 12, which is 3. Ah, right, okay. The formula for calculating transaction cost is transaction cost spread equals ask price minus bid price. Yep. Gross currency. So transaction cost equals, or spread equals bid price minus, oh no, ask price minus bid price equals ask price minus the bid price. Why is that minus so long? There we go. Gross currency. Cross currency, sorry. A cross currency is any currency pair in which neither currency is the US dollar. These pairs exhibit erratic price behavior since the trader has in fact initiated 2 USD trades. For example, initiating a long buy URGBP is equivalent of buying a Euro USD currency pair and selling GBP/USD currency pair. Cross-currency pairs frequently carry a higher transaction cost. So cross-currency is any currency pair which doesn't have USD. exhibits erratic behavior. I think that means volatile behavior and has a higher transaction cost. Margin. We open a new margin account with a Forex broker. You must deposit minimum account with that broker. This minimum varies from broker to broker and can be as low as 100 to as high as 100,000. Each time you execute a new trade, a certain percentage of the account balance in the margin account will be set aside as the initial margin requirement for the new trade. The account is based upon the underlying currency pair, its current price, and the number of units or lots traded. The lot size always refers to the base currency. The lot size, the amount is based upon the underlying currency pair, its current price, and the number of lots or units traded. The lot size always refers to the base currency. For example, let's say you open a mini account that provides a through 200 to 1 leverage or 0.5% margin. Mini accounts trade mini lots. Let's just say one mini lot equals $10,000. If you were to open one mini lot, instead of having to provide a full 10,000, you would only need to provide 50, because 10,000 times 0.5 is 50. Leverage. Leverage is the ratio of the amount capital used in the transaction to the required security deposit or the margin. It is the ability to control large dollar amounts of a financial instrument with a relatively small amount of capital. Leverage varies dramatically with different brokers, ranging from 2 to 1 to 500 to 1. Now that you impress your dates with a Forex lingo, how about showing them different types of trade orders? Right, so leverage. The ability to control large capital using a small amount of capital, and that is the margin. Cool. Types of Forex orders. However, I'm going to leave this episode here. So thank you everyone for watching, and I'll see you guys in the next video, which is types of Forex orders. Peace.